Hi everyone, and welcome back to a trade review video. In this video, I'm going to review 3 trades that our trading community have sent into me looking for feedback. There's 3 things I think you'll get out of watching this video. The first is I'm going to demonstrate a non-personal way to find the possible improvements that someone can make in their trades. Secondly, I'm going to break down trade reviews by looking at entry, management, and exit to find possible ways to tweak that trader's strategy. And 3, I'm going to give you a step-by-step process so that you can apply this to your own trades. So these trades are from 3 separate traders. What I've done is I've taken the information and put it onto the same platform. So there's no personal information on there. Those traders have been very kind, very brave, and courageous to allow me to do this. So a very big thank you to them. So let's start with trade 1. So we need a process to review trades. The way I review my own trades is I remove all personal from it. I'm only looking at whether something is strong, whether something is weak, or whether something was a mistake. And you can say, isn't strong and weak subjective? No, I'll give you my definition. A strong entry means that when I look at that entry tomorrow, next day, next week, it's still a strong entry. A weak entry is one that you look at later on and say, nah, that wasn't the best. And a mistake is it actually has an execution error. So step 1, we're going to look at the market structure. Well, this is clearly a bear spike. Here is a pullback and the first sell signal. Here is a second pullback and a second sell signal. So we call this a low 2. So if we're always in short, we're looking to sells. So the first thing I notice here is that this trader is not aware that we're always in short. The second thing I notice is we're at the bottom of a possible trading range. If you're looking to buy a reversal up from the bottom of a trading range, it's better to wait for a second reversal. So a trader should have waited for this bar to trigger and then wait for a pullback and for a second entry to buy. Because this trader has bought the first reversal, they were way too early to be trading this trading range. And in fact, everyone else was selling there. You can see there where the arrow is, the trader bought the close. Now, buying the close of a bull bar is a good place to get long in a bull environment. You can buy the close or you can buy on a stop 1 tick above the high. Here we can see that the trader has bought the close. However, in a reversal trade, the entry is 1 tick above the high. You need that price to get triggered, so you've got other bulls there. So the traders used the wrong entry type for a reversal trade. We looked at market structure, we looked at entry. Now let's look at scale-ins or add-ons. We can see here there are 2 add-ons. My comment here is there's no mathematical advantage to adding twice in the same bar here. If you were going to scale in, the scale in would usually be at a measured move down, betting that if I buy there and buy lower, I'll be able to get back to the midpoint. So adding in the middle here has no mathematical advantage because this is the biggest structure above. If this trader's entry was here and here, that would make sense. Scaling in once, and because 1 contract, add 1 more contract, that's 2. You're adding 2 contracts, that's 4. Average price there, average price here. We can see the trader would have broken even. That makes sense. It's not the easiest way to make money in this environment, but at least it has a mathematical logic to it. So those add-ons we know are emotional. This trader is panicking and there was no way for them to recover. Another trader might argue, well, this is the bottom of a trading range. If I buy the close, then I can get all the way back up here to break even. I think in this case, it looks good because the bar went all the way up there. But if you have a bear bar that's closing on its low, this is not a good place to keep scaling in. But in terms of an exit, he gets a tick for the exit because now you've got a breakout and follow through. So that is the correct exit point of that trade. So I would recommend for this trader to practice spike high 1, spike low 1, looking at pullbacks. I've got a number of videos on my channel where you can practice that drill to ensure you're aligned with the always in direction. The trader also needs to practice whether using buy the close or buying on a stop 1 tick above the high is correct for a particular entry. And if you're taking a reversal, I think traders should wait for the bar to trigger. And the last video I recommend for them is looking at second entry. So that was trade 1. Let's have a look at trade 2. So trade 2, you can see we've got a buy there and you've got add-ons all the way down and a final exit down here. Now, full disclosure, I have loads and loads of charts of my own trades that look like this. I probably did this kind of trading for years. I lost so much money doing this. So I'm giving feedback while at the same time remembering that's just what I did. I would trade very well for 4 days. of the week, and on the 5th day like this. I trade very well for 20 days of the month, and the last day of the month, I trade like this. So let's break it down and follow that process. Market structure, add-on scale-ins. Well, are we always in long or always in short? That is the swing point for the bears. We're always in short below the moving average. We're in a bear channel. Yes, we broke a trend line, but the bears never had their stop run. A trader who is buying here is betting on a reversal. The problem is you're buying here with a stop down here, and the target everyone's going for is right above. So I don't think this was the correct trade based on the market structure. So for me, that is a weak entry. If you wanted to trade the wedge bottom, then your signal bar is here, and you would get filled on this bar here. Not a great entry bar, follow through okay. Now you got a big bull bar, you're back to your entry, and you had all this time, if you took the wedge bottom, to decide that the wedge was not working, and you could actually have gotten out break even. I know what the trader was doing. Here's a bull spike, here's a high one, and the buy is one tick above that. But can you see in terms of execution on the entry? Let's go to number 2, the entry, the mistake they made. Here's the magnifying glass. What's wrong with this entry? Well, if you're waiting for a breakout and then a high one, you're waiting for the bar to print, and then once again, you have an order one tick above the high of that bar or at the close of the bar. So the arrow should actually be on this bar. That's where they got filled. The traders saw this spike, saw the pullback, probably had an order somewhere down here that didn't get filled. They're starting to panic on this bar that they're going to miss the spike, and they get filled at the high of that bar. So that's telling me that this trader, not willing to trade the wedge, a low probability signal for a big swing, they wanted a high probability breakout pullback. They then got emotional up here and entered at the top of a doji. So that's on the entry. What about add-ons and scale-ins? Well, before we go on to that, I want to make one observation, which is this trader actually had plenty of time to get out of this trade. If this is a spike and a breakout, high ones, high twos do not sit around for 5 bars and create doji, especially when they dip below the moving average. Any trader that bought up here had a chance to get out break even. But what did this trader do? This trader added on. So if I think back to how I used to trade when I was a terrible trader, I would turn a breakout trade into a trading range trade. I'd say, yeah, I'm buying there, but if this is going to be a trading range, I'll buy more here. I'll buy at 50%. I'll buy at the low. Now, I highly recommend you take a look at your own trades and keeping a trade. If you're taking a breakout trade and it turns in to being a very deep pullback, I recommend you get out of that trade and look to enter a new one with your new observation of the market. If you turn a breakout trade into a channel trade into a trading range, what you're also going to do is scale into an opposite breakout. And that's what this trade has done, in my view, because they were not disciplined to cancel the breakout trade here, because they added so many positions here. Okay, once again, like the first example, there's no advantage to adding 3 times on this bar. If you're buying here, you buy at 50%, you probably buy at the low, you're expecting a trading range. But the fact that this trader closed below the low of that possible trading range means they didn't understand the bear breakout. They didn't understand the possible trading range. And by the time they added 1, 2, 3, 4, 5, 6 positions, it was too much pain. So that's also telling me that their size on their initial position was probably too large. If a trader wants to buy and scale in, where's the first scale in? Well, the first scale in would be below the bull spike. But if I had scaled into a position here and it's now 3 bear bars, I would immediately exit on that close. I would sell the close of that bar, which closes my long position. I would not be in here. And I think a lot of traders ended up doing that. Some traders hit sell for a scalp to run the stops. Bulls who were buying and scaling in had to take a big loss. So the presence of this exit and this scale in tell me they were not prepared to add, to buy, to add, and then scale in down here. You can see that the measured move did not hit the stop down here. So anyone that's trading a trading range is allowing for the possibility that we're going to go have a failed breakout and reverse. So I'm saying this with respect and kindness because I have absolutely loads of those trades. But you can see when I break it down, hopefully, that if a breakout trade has a scale in, we're not going to keep buying below the low. That breakout has failed. But if we're betting on a channel or a trading range, then our scale-ins will not be close to our entry. We're actually going to scale in at the low of the spike, betting that we broke out of the top. We're not going to successfully break out of the bottom. And that's how a trading range works. But you cannot trade breakout, pullback, channel, and a trading range in the same trade. So what would I recommend this trader to work on? Well, once again, market cycle. Are we always in long or always in short? If we haven't taken out a swing point, then don't look for counter trend trades. If you want to take a wedge bottom, then you need to take the wedge bottom when the signal forms, and the signal's not going to be looking good. You don't want to take a great looking signal high because it's a reversal. You want to take the signal that's low. It's a low risk, it's a low probability, you're looking for a swing. Otherwise, do nothing. This is a bear spike, you're waiting for a pullback, didn't go below that. That's the low one, that's the low two, but it's a weak signal bar. Now you got consecutive bear bars. Looked like a lot of traders sold below that and that. So you can see this trader was doing the exact opposite of what all the very patient pullback traders were doing. I just put together a new video on pullbacks, so I'd recommend the trader watch that one. How about we have a look at example number 3? I remember trading this day. So the open was here. We had a really tight trading range, and you can see we made a new low of the day. This is what we call an expanding triangle pattern. These are patterns that have taken loads of money from me, and I'm sure many other traders. So if you see an expanding triangle on the open, you have to be incredibly careful not to suddenly think it's going to become the world's biggest breakout. If you have a look at all the price action in here, if we break out, the only long trade is pull back and then a buy signal to go higher. The only short signal is a breakout pullback and a signal to go lower. And you can see that neither of those form. So let's follow our process. Market cycle, entry, add-on scale-ins, and exit. Well, what do we know about the market cycle here? Well, like I said, it's a tight trading range, expanding triangle. This is a breakout and follow through. So I understand the entry up there, and I'll explain to you why that don't make sense to me. If we look at that entry, it looks to me like the trader wanted a pullback, which would be above the high of that bar, which would be above the high of that bar, or which would be below the low of that bar. They would be all the pullback entry. But an entry there, perhaps the market dipped down and went back up, and they bought this intra-bar. Trading with limit orders is a more advanced style of trading, and I recommend, particularly for beginners, that they don't trade that way, because this is the kind of stuff that happens. Now you're looking at your trade and like, why would I buy that there? So I think the trader missed the pullback, but tells me they did understand they should have bought at that breakout. So this entry was a mistake. This entry was okay. To be honest, I do that a lot. But if this entry is here, the exit needs to be below that bar. So you buy on a limit with the breakout pullback, but then that closes on its low, you immediately move your stop one tick below that bar. So we should have seen the exit there, but the exit is not there. The trader further scales in. So now the trader has switched from breakout trading to trading range trading. In a trading range, you buy below bull spikes, betting that the market's going to go down and come back. You sell above bear bars, betting the market's going to go up and come back. So if you ignore both of these entries, if a trader bought there and scaled in a measured move down, they could have actually got out break even. The more patient traders would have been willing to buy below there, betting that this is not going to get a second leg down. And when this had one reversal and a second reversal, those traders would have bought more, betting they would close the breakout point and get back to the moving average. So that was the buy in a trading range. So the entry was a little bit emotional. This add-on was okay, but it should have had an exit. This entry doesn't make sense if you've already got 2 on there. And then this exit, you can see now they've realized they're doing the wrong thing. It's time to get out. So I think that's an okay exit once you realize you're making a mistake. But really, if you're taking a breakout trade, the exit should be at the lows where your stop is. So my recommendation for that trader is to practice trading range trading and look at many charts where the charts have a breakout that fails and comes back. You'll often find the breakout pullback is a much safer trade there. At least you can minimize that loss, as opposed to buying the top tick of the day and then going right down to the bottom tick of the day and taking a big loss. And you're stuck in a trading range, it's very difficult to make that loss back. Well, that's the end of this trading review video. I hope you found that useful. As a little recap, I review my own trades exactly the same way. No personal, no good or bad, just a 4-step process. What's the market cycle, add-ons and scale-ins and exits? So there's 4 points to it. Is it strong? Is it weak? Or is it a mistake? And then from there, I'm looking to keep an idea of the repeated mistakes I make so that I can go and do remedial work on those particular structures. Well, thanks very much for watching. Please let me know in the comments below what the repeated mistake you make is. And if you'd like for me to review one of your trades, please get in touch. My name is Tim Fairweather from Zen Trading Tech.